You're here because you want to get a solid handle on important stuff, right? Without getting totally lost in the weeds. We get it.
Yeah, but that's the goal.
And that's exactly what this is about. Today, we're tackling something that sounds pretty basic, how central banks use interest rates. But we're going to dig in and uncover some really, well, unexpected angles.
Exactly. We're going to be looking at the policy interest rate from a perspective that might be new to you, modern monetary theory, or MMT. And we're really leaning on the insights of Mosler and Armstrong here.
So our mission today, essentially, is to unpack the usual story about central banks and interest rates, and then see how MMT kind of flips that script.
Yeah, challenges the conventional view.
Get ready for some potential, light bulb moments as we question some long-held beliefs. For anyone wanting to check our source, we're diving into MMT Unplugged, Episode 11. It takes a really critical look at this.
That's a good one.
Okay, so let's get started. Let's look at the standard explanation first. How do central banks typically use that main tool, the policy interest rate?
Well, the conventional wisdom is pretty direct. The policy interest rate, that's the rate, banks charge each other for borrowing reserves overnight.
Reserves being like the cash banks need on hand.
Exactly, yeah. That rate is seen as the central bank's main lever. They set a target for it, using tools like open market operations, buying and selling bonds, and adjusting the interest they pay on reserves held at the central bank.
Right.
And the idea is this influences borrowing costs across the whole economy.
Right. So the typical story goes, if inflation's too high, the central bank raises that policy rate, which makes it more expensive for banks to borrow, and that cost gets passed on, right, to businesses, consumers with mortgages, credit cards, even the government.
That's the theory.
The idea being that higher borrowing costs mean less investment, less spending, which cools the economy down, brings inflation under control. That's tightening.
Precisely. And then the flip side, if the economy is slow, maybe it needs a kickstart, the central bank lowers the rate. Easing, yeah. Cheaper borrowing is supposed to encourage businesses to invest, consumers to buy more stuff, boost activity.
And this supposedly ripples through various channels, like credit, asset prices.
Yeah, credit availability, asset prices like stocks and bonds, exchange rates, even just like how optimistic people feel expectations.
Okay. Now, this is where it gets really interesting. You often hear central bankers talk about the neutral rate of interest, sometimes called R star. What exactly is that? And why do Mosler and Armstrong think we should be maybe a bit skeptical?
Right, R-star.
Yeah.
It's a theoretical sweet spot. It's the real interest rate, so the stated rate minus inflation that would theoretically keep the economy humming along at its full potential without causing inflation to rise or fall too much.
So it's like the Goldilocks rate?
Kind of, yeah.
Yeah.
And central banks spend a lot of effort trying to estimate where this invisible R-star is and then, steer their policy towards it.
But Mosler and Armstrong argue that chasing this R-star is maybe a pointless exercise, especially for countries like the U.S. with their own currency and a floating exchange rate. What's the reasoning there?
Well, their argument goes back to the history of the concept. The idea of a neutral rate, it really gained traction back when we had the gold standard fixed exchange rates. That was the norm.
Okay.
Back then, countries needed to keep a certain amount of gold to back their currency. Interest rates were a tool to attract gold in or, stop it flowing out. A neutral rate then was one that kept the gold reserves stable.
Ah, okay. So it was tied to a physical constraint, the gold. But that's not the case now with floating currencies, is it? The central bank isn't limited by gold.
Exactly. Today, with a floating currency, the central bank just sets the policy rate. Period. Mosler and Armstrong argue there isn't some, natural market-determined neutral rate out there waiting to be found.
So clinging to it is like using an old map.
That's a good way to put it, yeah. They think it's an outdated concept for the current system.
Okay, so if MMT challenges this traditional monetary policy view, what do they say is a really important effect of changing rates that often gets overlooked?
This is really a key insight from MMT. Changes in interest rates have a huge impact on government finances. It's a fiscal policy effect, and it often gets, overshadowed by all the talk about monetary policy.
Fiscal policy, meaning government spending and taxes.
Right. And to get this, you have to remember that governments usually have debt, treasury bonds, the national debt, and they pay interest on that debt.
Okay, makes sense. And who gets those interest payments?
Mostly savers. People holding bonds, banks, pension funds, insurance companies, even other countries.
Got it.
Now, when the central bank raises its policy rate, that generally pushes up the interest rates on new government bonds, too. It takes time to feed through to all the debt, but the direction is up.
And this is where that fiscal impact MMT highlights comes in. Higher rates on government debt mean the government pays more interest to these bondholders. How does MMT see that affecting the economy?
Well, MMT views these increased government interest payments as essentially putting more income into the private sector.
Like a government spending increase.
Exactly. It's like the government is spending more, just in the form of interest. So think about it. The central bank is trying to cool the economy by making borrowing expensive,
Uh-huh.
but these higher interest payments are simultaneously giving more money to savers, who might then, spend or invest it.
Wow, okay. That's real contradiction, isn't it? The very act of raising rates to fight inflation could, through this fiscal channel, MMT points out, actually boost the economy by increasing income for bondholders.
It could potentially work against the intended cooling effect on borrowing, yeah.
Like pressing the brake and the gas at the same time.
That's a good analogy. And the opposite happens when the central bank lowers rates. Government interest payments go down. MMT sees that as a form of fiscal drag, basically taking income out of the private sector.
Fiscal drag.
And this might help explain why, say, when Japan had near zero rates for ages, they didn't see the big jump in inflation or borrowing that conventional theory might predict.
Because the lower government interest payments were acting like a drag.
Possibly, yeah. It could have been a counterforce working against the cheap borrowing incentive.
This leads to a pretty radical idea some MMT proponents talk about. A permanent zero interest rate policy. ZRP, what's the logic there?
Yeah, ZIRP. The arguments for it, especially from people like Warren Mosler, hit a few points. First, they argue it's fairer, less regressive.
Fairer, how so?
Because positive risk-free interest rates, like on government bonds, mostly benefit wealthier people and institutions who hold lots of those bonds. ZIRP stops that automatic flow of income to bondholders.
Okay, that makes sense. If you get a guaranteed return, the more bonds you own, the more you benefit. Taking that away changes things. What else?
They also suggest it could lower borrowing costs for businesses, maybe make investment a bit easier. Though, MMT generally stresses that business investment depends more on expected future profits than small rate changes.
Right. Expectations matter more.
Yeah. And of course, ZIRP would lower the government's interest expense. But again, MMT emphasizes the government as the currency issuer isn't constrained like a household budget anyway.
But maybe the biggest MMT argument for ZIRP is what? That it clears the decks for fiscal policy.
Exactly. That's probably the core of it. ZIRP would let fiscal policy, government spending, and taxes become the really clear primary tool for managing the economy, for aiming for full employment and stable prices.
Because it's seen as more direct.
Much more direct, and they argue more effective than fiddling with interest rates.
Yeah.
With rates at zero, the impact of, say, a tax cut or a spending program would be much more obvious, not muddied by whatever the central bank is doing with rates. Mosler even suggests that with ZRP and also paying zero interest on the reserves banks keep at the central bank, the government might not even need to issue as many bonds.
Interesting. So if MMT doesn't see interest rates as the main economic steering wheel, what is the central bank's main job, in their view?
Well, MMT highlights several crucial roles that are quite separate from that kind of macroeconomic fine-tuning. Top of the list. Lender of last resort.
Preventing bank runs.
Exactly. Stabilizing the financial system in a crisis, providing emergency funds to banks that are basically sound but facing a liquidity squeeze, that's vital.
Absolutely. What else?
Guardian of the payment system. Making sure all those trillions of dollars zipping around electronically every day happen smoothly and safely, that's just essential infrastructure.
Can't argue with that.
And finally, financial regulation and supervision. MMT generally favors strong regulation by the central bank to keep the financial system stable and stop banks from taking excessive risks.
So basically, MMT sees the central bank's key roles as ensuring financial stability, making sure payments work, and supervising banks, not trying to manage the whole economy day to day with interest rates.
Precisely. These are seen as critical core functions, quite distinct from the complexities and maybe unintended side effects of using interest rates as the primary tool for managing the broader economy.
Okay, let's try and wrap this up for you listening. We've just gone through a pretty different way of looking at central bank interest rates thanks to MMT. It definitely gives us another perspective to chew on.
Absolutely. The key things to take away, I think, are MMT really questions how effective or even central the policy interest rate is for managing the whole economy.
Right.
That the idea of a neutral rate, R star, is probably an outdated concept for countries that issue their own floating currency.
Okay.
And maybe the big one, that changes in interest rates have this significant fiscal impact through government interest payments, adding or subtracting income from the private sector, which often gets ignored.
Yeah, that fiscal channel is fascinating.
And finally, because of all this, some MMT proponents argue for a permanent zero interest rate policy, ZIRP. They think fiscal policy should be the main tool, and ZRP could also help reduce wealth concentration from interest.
So here's something to really mull over. If this MMT view is right, or even partly right, if the standard story about interest rates is incomplete or maybe even a bit misleading, how should that change how you think about economic policy?
Yeah, how should we evaluate what governments and central banks are doing?
Should we be focusing much more on government spending and tax decisions? And on the central bank's role in just keeping the financial system stable, the payment plumbing working, rather than obsessing over every little quarter point rate hike?
It definitely shifts the focus, doesn't it?
Definitely food for thought.